Let me just share my screen. All right, let's get started. Today, we're going to talk about how to invest like Warren Buffett. And he's definitely quite a character that I have been studying for the all my career since I started in this industry about 20 years ago. And it's always so much fun learning about him, and it's a never-ending journey, and constantly learning something new, constantly trying to see how we can improve our own investment process to be more aligned and more logical, like how Buffett thinks about investment. So, as always, please note that this is a webinar for education purposes only, and I myself is working for iFast Global Markets, and this does not represent the company opinion on anything. And we're going to discuss a few stocks today as well, and we're going to look into some of the things that how we should analyze on the company, and do note that these are all expressed in my own personal capacity. And welcome everybody to our premium club. And if you're new and this is the first webinar that you have joining us, do note that I do this quite regularly, almost every 2 weeks, and I'll be trying to put in more and more content. Hopefully, I will be able to ramp it up in making this webinar a weekly thing. And within all these webinars, sometimes we talk about personal finance, sometimes we talk about risk management, sometimes we talk about individual stocks or ETF or funds that we analyze on your behalf. And sometimes we just talk about interesting investing stories and theory. And so definitely, this would be some of the content that you will see over the following weeks if you keep following, if you continue to follow some of my updates on my mailing list. So if you want to get to be connected and also to get the most updates on what will be coming next and what will be the topic that I'll talk about in the future, do sign up for our mailing list at learnwithstanley.com. All right, as I mentioned, I am currently an advisor with iFast Global Markets here in Malaysia. I'm actually linked to the Johor Bahru branch, and iFast Global Markets is basically a wealth platform that allows you to connect to all the major asset classes that you need to have a diversified portfolio, and it will be a one-stop platform for all your investment needs. And we allow you to see all your investment within our platform in one single tap. So it's easier for you to manage both in terms of buying any funds or stocks, or even just your cash account, where we provide weekly interest on the cash account as well. Right? This is just a sample of my personal account on what I'm building, a sample ETF portfolio for some of my clients, just for them to update and see how I'm thinking about building a diversified portfolio based on ETF alone, and I'll be adding on to this over time. I'll talk a little bit about my own process, and also my process with my clients on how I review their financial status and finding ways to maximize their investment process for them to build long-term wealth for everyone. Okay. And of course, all these are tied to my own philosophy, where I really believe that we have to think long-term when we are building our wealth, in terms of spotting long-term growth opportunity in the market, and not really trying to time the market and trying to invest in things that just in vogue at the moment, right? And a key part of what I do is really risk management, of trying to protect the downside risk for everyone, for my client, for myself, and just keeping calm through market cycle. And we're going through one short market correction cycle right now, and it's a great test for everyone. And I'm always very excited during such event. It gives us more opportunity to buy at a much more attractive prices over time. And the key here is really to build an everlasting portfolio, something that will last us for many years, to reach our own financial goals, regardless of what it could be. So this is just a tracking of my own portfolio that I've done over the past 16, 17 years. I like to track my own portfolio as if that it is like a fund. And I want to see how well I have been doing objectively over the many years. And fortunately, I have been able to be relatively successful when it comes to building my own portfolio. And hopefully that translates to how I can present and help my client as well. Okay, so if you're interested to actually speak to me on a one-on-one basis, you can always scan the QR code here, and it's just a Google form to let me know that to reach out to you. And when I do my next review, I'll definitely reach out to you. Or you can also reach out to me through WhatsApp or email. All my contacts will be on learnwithstanley.com. Okay, down to the topic today. We're going to talk about how to invest like Warren Buffett, and I'm going to split it up into 4 key areas, and that will be trying to understand a little bit about the history of Warren Buffett himself. There's actually 2 Buffett in my mind, right? One is before Berkshire, how he invests, and after Berkshire Hathaway, how he invests. And what's the key difference, and why it has actually, that transition of him, that the evolution of him actually brought to a much bigger success that he will ever imagine after that transition. And when we look at the mega growth, how he has built that, and from all the research that I have done on him, reading every single book that I can find on him, trying to understand from all the investment letter that he has written before, not just the shareholder letters from Berkshire Hathaway, but also way back to his partnership investment days, right? Previously, he was like a private fund manager, and all the letters that he wrote since the beginning that he entered the industry. I spent a lot of time reading them and rereading them, what exactly he's looking for when he thinks of investing and finding a possible investment opportunity. Then we'll come back and summarize that into a checklist. And lastly, I'll go through an actual practice of how you and I can perform what we learn from this webinar today. How's that sound? Yeah? All right. So Warren Buffett, of course, now everybody knows him. But way back in 1965, he was also already quite a successful fund manager. He runs a private partnership. So in the past, the fund management industry maybe wasn't so established where you can have a proper fund structure. What he did is really basically just create like a company, which is a partnership company, and his investor will be investing into this company, and then he invests the funds that is inside the company, and they call it a partnership. So I think he runs like 11 partnership or something from different investors. And by the time 1965, he was already very successful, and he has actually liquidated all his partnership because he has reached a point where, number one, he felt that there wasn't much bargain left in the market, and number two, I guess he feels that it's worth his time more to just manage his own fund. So he has actually liquidated all his partnership, and he's just managing his own fund. And the one person he always talked to discuss ideas is his partner, his late partner, Charlie Munger. And by 1962, he has bought into this company called Berkshire Hathaway. And a big part, I think more than half of his own personal wealth is in this company, Berkshire Hathaway. And Berkshire Hathaway is actually a dying business. It's in the textile business in America. And this is the time where it's becoming less and less competitive to be in the textile market. Foreign imports are coming. Just American companies not able to do it at scale and as cheaply as foreign imports. So the business is slowly deteriorating, but he buys it because it's a very cheap stock. And he has bought it, over the years and hold it. And he is basically one of the largest shareholder, a passive shareholder in the company. And so you can imagine, being such a large individual shareholders in this stock, the owner will be a little bit worried. What is this guy trying to do with the company? So in 1965, the owner actually comes to him to say that he want to buy Warren Buffett out. So Buffett was actually okay because to him it's just a stock. He makes some return. He's okay to walk away. And they actually agreed to sell the company at $11.50. And he agreed. But when the offer came from the lawyer to sign the document, the offer was dropped to 11 3/8. So in the past, in the US, their pricing is in terms of fraction. So that will be around $11.38, right? And that angered Buffett. And instead of just selling it back to the owner, losing a few percentage point, maybe that's 2%, he got angry and he buy up even more stocks until he became the largest shareholder. So although there's no real explanation on why he did that, and especially Warren Buffett pride himself as being a very, very logical guy, to him, logically speaking, it's really not much of a difference, and it's better off he sell it and then he finds something else to invest in. He himself has mentioned that buying Berkshire Hathaway is one of the worst mistakes he has ever made in his life, right? The worst investing mistake he has made in his life. Because without locking the capital up in Berkshire Hathaway, he could actually invest and grow the money even faster if he has just the liquid cash from the sale. So that's from his own admission. But by reading through a lot of his biography, I feel it might, okay, this is my own deduction. I feel it might has something to do with the death of his father. Because just a few months before this offer came about to sell out Berkshire Hathaway, his father actually passed away. And he has quite a close relationship with his father. And I feel that might still be impacting him, which push him to make an emotional decision from what happened, right? I don't know if that's the truth, but it's just how I read the things from all that I have researched on him. But doesn't matter. He actually really took over the company in 1965. And he basically booted the chairman out of the company and made himself chairman and CEO. And what he did was that he did a few things. So Berkshire at the time has a big cash pile, and which is a reason why he buy into the company, is that this company has a lot of cash, but it's not doing much with the cash. It's just sitting in the bank. And he started to invest that cash. And some of the few things that he started buying are insurance company. He bought a few insurance company, namely the National Indemnity Company and National Fire and Marine Insurance Company, within the next few years. And from there, he built that company up for the past 60 years. And that's how the share price of Berkshire Hathaway has performed till last year, I think. About 4.4 million% of return compared to 31,000% of return on the S&P 500. So on this graph, the S&P 500 is almost a flat return. But bear in mind, the S&P has actually returned 312 times, right? 312 times. That means that if you have invested $1,000 in S&P 500 in the past 60 years, it grew into $310,000. But the equal amount in Berkshire would become around 44 million today. So that's the difference. But I want to share something interesting with you later. But you could also see that the real compounding never really happened until like 20, 30 years after he bought Berkshire. And in fact, the first 10 years when he bought Berkshire, the Berkshire shares actually underperformed the S&P 500. So for the first 10 years, the Berkshire stock was actually underperforming. But you can see the real impact of compounding as little by little bit of outperformance. You can see how much it shot up compared to the market. And in fact, when you look at his performance compared to the market, especially the recent 10 or 20 years, he's only earning just a slightly, little bit outperform of the market, maybe 2 or 3% better than the market every single year. But that 2 or 3% can compound into a very, very big difference if we allow the time to work. And that's, I feel, is the biggest lesson from this. By looking at Warren Buffett's life, the power of compounding really compounds if we allow it time to work the magic. Just a quick summary on what Berkshire is today. It compiles of a few business. Biggest one is, of course, his insurance business, where there's a lot of different insurance within the company. Another big part is utility and energy. It's actually one of the largest energy and utility company in the US. The next one is railway. It's also one of the few oligopoly of railways in the US and in Canada. Next, they have a bunch of business under servicing and retailing, and also manufacturing as well. Those would be considered the much smaller business of Berkshire. So I won't spend too much time into it, but generally you can see that it's split between different parts of the segment of the business. You can see it as a conglomerate, but another big part is this 40%, which is all coming from their investment gains. And they have, right now they earn about close to 40 billion in operating income every single year within Berkshire. Just run through Berkshire model a little bit. And this is something that we can duplicate as well in our own life. And something that I actively try to see where I can learn and copy it into the way I manage my investment as well. And basically, Buffett by himself, and also just a few members of the staff is stationed in the HQ. I think they have just 20 people in the HQ itself. This is a business that is a top 10 business around the world and employs 300,000-400,000 people globally. But yet in the HQ, roughly about 20 people in the HQ. And what the key role of HQ is really planning on how to invest the money that they have earned. So in the insurance business, they have something called float, where when I pay a premium, the money is given to the insurance company, and the insurance company can decide to use this money to invest in something. And of course, they have to have some cap away so that they can pay out for claims that happens. But generally, an insurance company can sort of work out how much buffer they need. And so they are able to invest this float that is the money they collected from premium. So this money will go to Buffett and his team, and they will invest the money. And then from that, they could sometimes buy an actual business. So they could acquire a lot of businesses that generate more profit for them. And over the years, they have made a name for themselves to buy out a lot of family-owned businesses, businesses that has been family run, and the family, maybe the next generation, is just looking to sell it away and not interested in running a business, or they plan to run it, but they just want to cash out a little bit and make themselves more liquid from the business. and Berkshire will basically buy the business, and they still let it run by itself. He wouldn't interfere with the management of the business, but only a few things he want them to agree to him, which is that whichever excess profit that they made, they will send the money back and dividend back to the HQ, and Berkshire will decide how they want to invest the money again, and they can invest it into more stocks or buying other companies as well. And so it's a flywheel that continues and perpetuates itself, that every single year they make more money, and then money go to Buffett, and Buffett find more things to buy, and over and over and over again. But there's a key thing that I mentioned, that there is a before and after of Warren Buffett and his style of investing. And I'll call it BC and AC, right? Which is before Charlie and after Charlie, which is his partner, Charlie Munger, which in my mind is the greatest influence for him, and it's also, my own personal investing hero that I look up to a lot. And it is Charlie Munger's life that I truly admire and want to emulate, and not really Buffett. And what Charlie really taught Buffett is to change his view set on just buying very, very cheap companies in the past, where he looked at companies that are very, very cheap, like Berkshire Hathaway itself. The business wasn't great, but it's just at a very, very discounted price. And he don't give a lot of consideration to the quality of the business. He's just buying it because it's cheap, and he thinks that he can make money over time. Whereas Charlie really kind of introduced to Buffett the idea that you should actually think about buying higher quality businesses, company that have what we call a strong moat, that can continue to do well over time, and they're consistent, and the brand and the company is durable. They can grow for many, many, many more years. And for this kind of business, actually, it's okay to pay a fair price. We don't have to always be paying at a discounted price. Some of these great businesses, they don't come at a discounted price that often, and even at buying them at a reasonable valuation, because they are continually growing over the years, you can still make money quite a lot from them. So that's the key difference that sparked the way Buffett really look about investment. And I categorize it into four main categories that he want to look at. Number one, of course, is the business, to find the business, to evaluate the management, to look at the financial that it makes sense, and looking at the valuation right at the end, the last one. Okay, we're going to talk about all this in detail, step by step. So the first one is actually understanding the business, and some of the key checkpoints that we can look at is finding a company that is simple and understandable, right? You understand the business model by reading the company, or by just maybe watching a segment on YouTube describing the business, that you understand what the business is really about, how it attract customers and everything. Understanding and looking into their operating history, that do they have a consistent operating history, and also do they have long-term favorable prospect. So let's play a little bit a small example. We're gonna make it a little bit more interactive, right? I'm gonna over this 12 step that we're gonna this 4 step that we're gonna talk about. I'm gonna look into 2 companies, and we'll use these 2 companies. These are actual companies that is listed on the stock market, and we will go through each of these criteria and evaluate them in terms of what I can find about them on the internet. Okay, so number 1 is trying to find a company with simple to understand business model. This is snippets that I got from the company website itself. So this is how the company describe the business in their own words. So number one company say that on the website, there's only these 7 words, which is unlimited movies, TV show, and more. That's all. Okay, so you come to this website, they have unlimited movies, TV show, and more. Company 2, the way they describe themselves is they are a company supported by data-driven intelligence and advanced client technology. Each MX solution is designed to streamline the complexity of marketing, review cost efficiency, improve speed to market, strengthen marketing efficiency, and deliver sustainable business value. Do you understand what the company does? So I have to really dig quite into this company to really understand what they're trying to say. But at first glance, right, it doesn't even take that much time. At first glance, you can see from the company's own words that do they really know how to describe their business in simple terms? And is it a business that is easy and simple to understand that we get straight away? And I think in life and also in business, too many people try to make things too complicated with a lot of jargons and everything. From this company too, I think this copy was done maybe a few years back, but in today's time, I'm sure they were gonna add at the last phrase in this description, powered by AI, right? And that means everything. But you can see that if they're unable to describe their own business in simple languages, then just trying to add complexity to it and make it sounds intelligent, that's actually one of the biggest red flag that I look at when I research on a company. So that's just number one. Number two, we look at whether this company has consistent operating business. This is just data coming from our iFast platform. And do note that, so on the left is actually the latest one. So 2004 is over here, while 2020 is all the way on the right. So you read from right to left. But you can see that this company number one, revenue, the blue color revenue is growing okay. And profit is also growing pretty decently. This is company number two, revenue not really growing, and profit very, very minimal. Yeah, you can see that some years they are making losses, some years they are profitable, but even when they're profitable, the margin is not that impressive for company number two. And next one that we talk about is making sure that this company has long-term prospect. So company number one is in the entertainment business, and this industry, from what I found from statistic companies, is expected to grow about 6.9% a year over the next 5-10 years. The market size could become like a $155 billion market size in 2029. So a sizable market, but not fantastically big. Whereas number two is actually in the very, very big market, is in advertising. And this advertising market is a $1 trillion market, and is still growing at roughly about 7.9% a year. So it's growing even faster than the industry that company one is in. And it's also a US company, so located in the economy that has the largest ad spend, which is US and China at the moment. So it's in a perfect, great, high prospect market. So there's something to keep note of. Okay, so now we already, just by going through step one, we have a rough idea of the two companies. Of course, along the way, you can let me know what do you think company A is and company B is. Feel free to open up the chat and then put your thoughts in. And also every time we go through each checkpoint, share your opinion with me. And then let me know what do you think on that matrix alone of the company A and company B. Okay, so now we look at the company in terms of its business prospect already and business side. Number two, let's look at understanding the management. So understanding the management, there's some things that we want to look into, and it's something also that Warren Buffett constantly talk about if you read on what he writes and what he talk about in interviews, which is we want to find management that has pretty good capital allocation skills. I'll explain a little bit what that means and how we can look at that. We want to find honest and transparent management that they can share good news and bad news with us candidly. And number three is we want shareholders that focus on, we want management that is also focused on shareholders' interest, means their interest is aligned. They want to build shareholders' value for the long term and not just worried about their next year bonus or how their options is going to expire and how would that impact them. So all this we want to look at. And a sign of great management, of course, the first one I would say is very, very important is understanding if the management has very good capital allocation skill. So the way I view how people interact with money tells me a lot on their ability with money, right? It doesn't matter if you're spending your own money or you're spending company money. How you spend the money can give us a sign, an indication of how well of a capital allocator you are. And what I mean by capital allocator is if you have this amount of money with you, what are you doing with it? So as an investor, of course, we want to grow our own wealth as fast as possible, but also to reach a life, we still want to have a lifestyle that we want, right? So there is always a balance, and how we choose how much money we want to invest or how much money we want to spend, that is actually our own capital allocation skill, right? For someone who can deprive himself of all the luxury in life, right, and just live with the bare minimum and then invest everything, sure, he or she might be very good at improving his own wealth, but at the detriment of his current enjoyment and his current lifestyle, right? Similarly, this is also a trade-off that a company will need to make. What are you using the money now for versus what are you using the money for the future? And a good way, for at least for shareholders or investors that invest in a company, we want a company to be able to allocate that money into something that will generate more income in the future, right? We don't want them to spend on the luxury today. We want them to save and invest in things that they will make the business bigger and bigger for us as shareholders. So one of the key metrics to look at is actually looking at the thing called return on equity. And return on equity is basically a formula where we use the net income of the company and divide it by the shareholders' equity. The shareholders' equity is basically the net income. The net asset, sorry, will be the net asset. So it's all the asset minus all the liabilities that the company has, and whatever it is belongs to the shareholder. And that figure will give us understanding of the return on equity. Why is this figure important? Because you can see it in another way, which is if you assume the shareholder equity is all the money that is worth to the shareholders. If today the company liquidates and basically sell off everything and shut down the business, more or less the shareholder equity is what the shareholder will get back, right? And this shareholder equity, in a sense, is an amount of money that the shareholder can get, the amount of money that we can get back as a shareholder. And if that is a tangible figure, and we use this figure to give back to the company and ask the company, okay, this is my money, you hold for me, make more money for me. And the money that they make is actually comes in terms of net income. So they're actually taking the shareholder equity and going up to do business and are making some profit from it. So when I look at a company, I typically don't look at how big the revenue is or even how big the profit is, but how big the profit is in relationship to the shareholder equity, right? Because a company can say that, in total, the shareholders invested 10 billion into it, and yet the business makes like maybe 100 million every year. 100 million is still a very big number, but if shareholder has invested 10 billion into it and is just making 100 million a year back, it's actually a 1% return for shareholders, maybe less than that, right? And which is not a very impressive amount, because putting into fixed D will earn more than that. So this is a number for us to compare how well the management can actually use the money to generate more money. And we have all this record, right? On our iFast platform also, you can get all this record. From other data provider, you will be able to get it as well. But you can see that company A generate about 25 to close to 40% return on equity for the company over the past few years. Whereas company 2 are quite volatile. Sometimes they make profit, sometimes they don't. And when they make profit, it could be very good, a 34% a year return. Sometimes they could lose 82% of net profit to equity. So they could lose close to the entire equity of the company in 1 year. Very suspicious kind of business, I would say. So from there, we already have quite a clear idea on which company might be better, which company would be safer for us to invest in as well. Next is finding honest and transparent management. This one will take a little bit of work, I have to be honest with you guys. This will take, for us as investors, especially for you, if you are doing your own investing by yourself, it will take quite a lot of effort on your part. And it requires us to actually go through all the transcript of the company, all the annual report of the company, all the documents that the company put out. And we're going to read through them, how they write and when explaining their business, when their business grows, or if their business is not doing well, are they sharing the real reason behind and telling us what went wrong, what could be done better, and how they can change things in the future. A good trick for us, if you're really interested in doing this, is to look at company annual reports on the chairman's letter or the management discussion on a few years apart. So maybe 3 to 5 years back, you find an annual report 3 to 5 years ago, read through, and then look at what the management is promising. Maybe at that time they say, we are planning to expand on this particular area. In the next few years, we expect something to happen. And then you read the current one and you try to match up. Does the story match up? Or has they totally forgotten what they have written, or they have brushed it off and set another new agenda? Like maybe a lot of times I read questionable companies is every single year they seems to be doing something with a lot of potential, but every single year they're just saying that something exciting is coming, but never really truly committing and executing on what they promise. So some of the times I find these kind of companies, and this is a big red flag for us. So you can always compare what they say in the past, and does it turn true in the current times? And even if it didn't turn true? Are they being honest about their mistake? About how they can do better? So this is a little bit a snippet from both their annual reports. It's a bit long, but bear with me. I'll just read what some of the key paragraphs that they mention. So you can see that this one is coming from annual report in 2022. And basically the management say, fellow shareholders, our revenue growth has slowed considerably as our result and forecast below show. So they have a table, and they say that streaming is winning over linear as we predicted, and their titles are very popular globally. However, there are relatively high household penetration, meaning that a large amount of households already have their account or their sharing account, combined with competition is creating the revenue growth headwind. The other one, company 2, in 2003, they say that we have achieved solid 2003 financial results, meeting our guidance across all metrics, but despite revenue being negatively impacted by external factors, including significant postage rate, inflation, economic uncertainty. So you can see that this company, they claim that they have done very, very well in 2023, but then go on to say that their revenue has dropped, has negatively impacted. They never say drop, they will say negatively impacted. And all this is because of external factors, right? It's nothing to do with them. They did a great job, but the external factor caused them to see revenue drop. And this year, when you look through their financial in the previously, maybe I can go through 2003, you can see that they actually make a loss in 2003. So I don't know where is the part where they say that they have achieved solid 2023 financial results, and yet revenue drop and the company is in a loss. And all this is not their problem, but because all these are external problems that they have no control over. So you already see which has a higher caliber of management just by how they word things, how they explain themselves in the management discussion. Okay, and next one we talk about is how to find companies that is shareholder focused. I'll link a link with you guys here. So for my premium club members, you can go to the website and download this PDF, and also you can take a read on this S&P Global report on what are some of the best practices of companies being shareholder friendly. So, but in summary, we want to look at companies that don't have a lot of dilution. The management pay is reasonable. We don't want company that have very, very low management pay, but we also don't want a company that has excessive management pay, right? They're in line with the market, maybe slightly higher than the market. That's fine. We want company with high insider ownership, so the management are actually investors in the company as well. They want the company to do well, they want the stock price to do well, and also looking at their merger and acquisition record. So why this is important is, number one, let's go from bottom to up again. Many companies would like to grow using M&A, and to the management, it's good for them because they get to manage a bigger company. That means a bigger paycheck. So some management would just buy for the sake of buying. They just want a bigger company so that they can say that they are $1 billion CEO rather than they are a $100 million CEO, right? And their track record might say a different thing, right? They can keep buying a lot of different company, but the result doesn't show, right? They could put the company into a lot of debt. The result doesn't really grow. Sometimes it even decline. And that means that they're just not really doing a good job as a manager. Insider ownership, that I think is quite straightforward. We want the manager to have a significant of his wealth with the company as well. So they think like owner. And if they are a CEO with 0% share in the company, then to them it's just a job. how the share price perform, how the shareholders' wealth is being destroyed is none of his problem or her problem, and that's not a good thing. Of course, net management pay is also quite forward, and also dilution. Dilution is something that I personally look at very, very closely, and it means it's a very serious indicator for me if the company is shareholder focused, because sometimes a company, they would dilute shareholder by a lot for making maybe M&A deals, or just raising more and more money for the company. Again, for the same reason that the management just want to be managing a larger company. So they would, find excuses and raise more and more money so that the company become bigger and bigger, and they can increase their pay as well, right? So all these are possible management flaw that we have to look out for. My own personal opinion on management is that there's never really good guys or bad guys in the management of a company, but there is self-interest in it, and everyone will look after their own self-interest, and we want to make sure that the self-interest of the managers is as closely similar to us as the outside investor or the company. That's all. Oops. Sorry. It went out into... Okay. Okay. Very good. How's everyone doing so far? If you have... this is the first step 1 and step 2. If you have any question up to this point, feel free to open up your chat tab. If you're watching from a tablet or a phone, just click on the 3-dot button, and then there's a chat button. If you're from a PC or a laptop, there at your control panel, you'll be able to see a chat button. And let me know some of the thoughts that you have, some of your comments that you have, or question that you might have. I'll come back to them as soon as I finish this section as well. So step number 3, now we're looking at the financials. I always believe that when we analyze a company or analyze a fund or whatever, what we are trying to do is really tell a story. But we want to tell a story by combining the narrative of the company with the numbers. And the numbers tells a story as well. So what we are trying to do is finding consistency in these 2 ways of telling the story. Meaning that the management or the news media or whichever that is associated with the company, when they write about the company, when they explain the company, there is one narrative, right? And then we look at the numbers of the company. That numbers should tell a similar story to us, and then we can have the clear picture of what the true story of this company is, like putting in a jigsaw puzzle and finding the real picture, how it looks like. And when there's inconsistency, when the management is saying something but the numbers don't really tell the same story, then we know there's an inconsistency, and it links back to the quality of the business and the quality of the management as well, right? Why are they not being candid with us? That's one thing. So financial, actually, it reiterates a lot of what we talk about in the first 2 steps. But here, we're just using numbers to double check what we have found. The first one, of course, again, is finding companies with high return on equity. High is a subjective term, but for me, generally, over the years, I come to feel that I want a company that at least generate 15% on return on equity. It's just a personal preference. I find that is a relatively good sweet spot where I can still find traditional brick and mortar business that generate this kind of return on equity, while also, of course, many of the tech companies, when they're profitable, easily they can have return on equity above 15%, right? So it gave me a good mixture that when I look through this company, I have a good mixture of businesses around. If I put it too high, very often, I pigeonhole myself into just one industry that is able to create that level of return on equity. So if you say I want the return on equity of at least 30% or 40%, most likely everything that you screen out would be software company, and end up that you can only invest in software company because these are the companies that will give that level of return on equity. And then in that case, you might not have a very diversified portfolio, right? So that, which is why in a long-winded way, I feel that 15% give me a good sweet spot to have a relatively good range of industry and companies. Next one is having a consistent earning growth, right? This includes your revenue, your earnings, and maybe even your cash flow. Then next is having low debt. I really prefer company with very low debt. And I feel that because at the end of the day, a company doesn't go out of business because it has no business, but it's because it has a very high leverage and they just don't have the cash flow to sustain it. Right? During COVID, many businesses actually shut down and their revenue went to zero. And some of these companies miraculously still survive, right? Even with zero business, their company continue to operate until the day where they can start operating again. And that's because all these business have very strong business sheet. Has very strong balance sheet. Sorry about that. Balance sheet and very strong cash buffer on their books. And so they are able to sustain any downturn that the world throw at them. And that comes back to the point where I prefer a company with very low debt. We'll talk about numbers later, one by one. And the last one is finding companies with strong free cash flow. First one, we already talked about the ROE, the company A and company B. We can see that company A is much more consistent and very good ROE over time. Consistent growth also, revenue growing, net income growing, not so much for company 2. Company 3, both has debt. One way that I look at it is the total debt divided by the equity. So again, just now we talk about equity being the shareholder portion of the company. And that is everything includes owning to supplier, owning to employee, owning to the banks, to your bondholders, everybody else. And typically I want the debt level to be lower than equity. So in this case, it's about 0.6 to equity. Still okay. But for company 2, their debt is actually 9 times more than their equity. So this means that if the company lose like 10% of the entire asset, then the whole equity would be zero. So the shareholders basically become bankrupt, more or less. Okay, so free cash flow. This is the term where we look at the cash flow of the company that it earns minus of whichever capital expenditure they need to reinvest back into the company. So here's a big difference between cash flow and net income. So in the company, when you look through the annual report, there is 3 major statements that you will want to look at. Number 1 is the balance sheet, which has the asset, liabilities, and equities, right? If this is something new to you, do check back on some of my old webinar that I explained this in much more detail. And then the second part is the net income. This is showing the revenue, the expenses of the company for the year, and then back to the profit. But one thing that I think many investors tend to forget is looking at the cash flow statement of the company, because the net income of the company, when it says that the company made 100 million profit this year, it doesn't necessarily mean that the company has 100 million of cash deposited into its bank that year. Because of accounting system, the profit is just a paper figure, right? And the cash flow, how much the cash actually move in and out of the company, will be documented inside the cash flow statement. And we want to make sure that over time, the company is indeed bringing in cash flow for the company, because the key objective of a company at the end of the day is to make money, right? And we want to make real money, which is cash coming into the business, instead of just paper profit that is showing up on the income statement. This can be different a little bit for specific type of this industry. Say, for example, in the financial world, sometimes their cash flow doesn't really matter a lot because their whole business is giving out loans. So their cash flow tends to be negative most of the time if they're distributing out a lot of their loans out, right? So for specific kinds of industry, sometimes the cash flow statement will not be that useful. But I would say for general, many business, typically the cash flow statement is very important. And something that we look at very with detail is free cash flow, which is all the cash that the company make from operation, right? When they're running a business, all the money that they made, minus off whatever capital expenditure they need to pay out again just to sustain the business or to grow the business. So we want that figure to be positive. And you can see for company A, actually for both companies A and B, in the long run, they both have positive free cash flow, which is actually good. But we can also see a big difference, which is company A, their free cash flow over the years, although not smoothly, is growing faster and faster, which close to $7 billion of cash flow that they make. And while company B, their cash flow is becoming smaller and smaller, right? Now less than half of what they started a few years ago. So that is also another indication. And now, finally, we come to the last part, which is understanding the valuation of a company. You can see that this is a very key point for us to take note, which is valuing a company should come last. And it does come last at the stage where how Warren Buffett look at the company. We should always ensure that the company that we are looking at is of high quality, the management is of high quality first, the prerequisite that pass all the tests first, and then we look at what is the price we should buy into. But for many investors, the process is actually opposite, right? When we look at the stock, wow, the stock is moving up, wow, Nvidia is moving up a lot, I should buy it because the stock price is going up. What does Nvidia do? I don't know, nobody knows, right? So that's something that we should catch ourselves on. We should remind people that we hold dear to and want them to make sure that they have they manage their money properly, which is valuation always come at the last stage after we have confirmed that this company is worthwhile for us to invest in. And how we look at it is, number one, intrinsic value. Number two, having a safety of margin. And number three, can this company be something that we can hold for the long term? Right? Valuation by itself is a big topic, so I will not touch on it too detailed today, right? There's different school of thoughts of how you want to look at valuation. Something that we might go into in the future is how do we actually calculate something called a discounted cash flow, using different type of maybe formulas that we can look at, maybe even dividend discounted model and things like that, all that I learned in the past. But I would say generally we don't have to be, we don't have to make things so complicated than it need to be. Because if we have done the first 3 steps well, and we have put ourselves having a high standard of prerequisite when we look at this company, typically a company that passed the test in the first 3, their profit and their cash flow would typically be, I would say, looking for the right word, would be of high quality enough that we can use simple valuation tools like price to earnings. Okay? And I would say that the higher the quality of the business, the more consistent and stable the business is, I would say I feel better using price to earning to value a company. So this company has a price to earning ratio of about 49 times, very, very high. And a forward PE of 40, also high. But interestingly, its 5-year average is about 51. So over the long term, its average PE has also been high. The company number 2 actually don't have any PE because it doesn't have any E. It doesn't have any earnings. It could potentially have earnings in the future, and they are expecting that they could have earnings in the future, and that will put it at a forward PE, meaning that the expected PE to be around 8, which is considered like a cheap, very cheap company. But again, this is a tales of 2 sides of a coin. Do you want a great company at a fair price, in line with its average, or do you want a fair company? I wouldn't even use the word fair company, but maybe a mediocre company, right? For the better lack of word, or a lousy company, if you ask me, at a great price, at a possible price of PE of 8 times. Right? 8 times to a stock market company is considered pretty cheap. And this is basically something that we have to ask ourselves when we come to investing. Exactly what is the strategy we want to employ? And I would say that having tried both, right, over the past 17 years, I have tried both. I would say that it has been far, far more profitable and rewarding to buy great company at a fair price. And it has been the case for Warren Buffett as well. It has been the case for Charlie Munger as well. When they turn to become investors that look at great companies, that is where they are able to compound their growth for the long term and truly build wealth over time, right? Next one is, once if you want to invest in a company, something that you might want to look at is, do we need a margin of safety? What does the margin of safety means? Margin of safety basically comes from an engineering term where an engineer is trying to design something, say a bridge, and this bridge could sustain a load of maybe a million ton, right? And when they build the bridge, they want to ensure that they build some margin of safety, meaning that they build this bridge to hold 2 million ton, but they will say that warning, the load of this bridge is 1 million ton, so to have some margin of safety, right? So they don't want to build right at the limit that they say that they could, because it could easily break if we're so close to the limit. How we look at margin of safety could be twofold. Number one, it could be from the price. So you can say that just now, okay, this company, a fair value is 50 times PE, but I want a margin of safety. Say I want a margin of safety of 50%, meaning that I will only buy company one when it becomes 25 times PE. That's considered price margin of safety, right? Another way that I look at it is we could add margin of safety just by making sure that the company that we buy is of utmost quality, meaning that the chances of this company ever becoming zero, or this company could ever go out of business, is very, 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 very slim. So when I buy into this business, I can pretty much ensure that I will die first before this company die. So that's something to look at it. And because we look at previously, the management is good, the company is not leveraged, then the company has a very good moat that it can continue business for a long time. That could add the margin of safety that it gives me confidence that I can invest in this company even at a fair price. So there's a few ways to look at a margin of safety. And last is holding it for long term. Because as we mentioned before, compounding works only if we allow the time for it to work. And when we buy such company, we have to ask ourselves, can this continue to grow for a long time? And I reviewed the company just now. Okay, but I'll go to the question first. But write down what do you think company A and company B is. But I'll just answer one question first. We have one question from Victor. Thank you so much, Victor. And you're asking, how about criteria for evaluating good management and capital allocator? I think we mentioned that just now. It really goes back to simple things like can the management reinvest the money at a good rate using ROE? Excuse me. And looking at the track record of their M&A, looking at their dilution track record, and how their pay structure is in. So if we study a little bit in detail in this, we can more or less see whether the company are good capital allocators or good management, right? So the company for company A is, drum roll, it's actually, I think it wouldn't come as a surprise, is Netflix, right? And this is the long-term stock performance of Netflix. And if we look at the accumulated return, you can see that this has indeed been a very, very good return for shareholders. The Nasdaq up about 1,000% since when this IPO in 2002. But the stock has gone up like 56,000 times. Okay, so 56 times more than the market. And this is how the share price look at, basically, from the beginning, right? But it's very easy for us to, look back 20, 30 years and say, wow, sure, this company has done well. But in the moment when you're investing in this company, right, in the year 2005, if I ask you to invest in Netflix, it's very, very difficult to spot this kind of company, right? And indeed, when I spot it, I'll just an actual example. I started buying this company, if I have my record correct, around 2018, 2019, like 2017, 18, 19, 19, I can't remember, around that period. I remember I buying it around $300 mark. Okay, that's when already Netflix is pretty dominant. It's already profitable, which is key, because in the past, for a big part of this history, they're actually not profitable, right? So by this time, I bought it. They're already profitable. They're already quite dominant, and they just they're doing pretty okay. Not that big of a risk of buying them. But you can also see, just because I find this company and it passed all the tests that we talked about just now, and I bought it, it doesn't mean the company, the stock will do well straight away, right? So one thing that we have to remember is the stock market doesn't care if we own the stock or not. Just because you buy it doesn't mean the stock has to start rallying, right? And case in point, I bought it in 2000. Let's put one of the dates, 2019, at about 300 plus. And for the, let me see, 19, 20, 21, 22, 23. So for 4 years, I own Netflix. I actually lost money on it. After COVID, it actually crashed. So for 4 years of holding on to Netflix, I actually lost money on Netflix. But then from the short rally last year, if I work backwards on my yearly return since 2019, 2018, I actually still earn about 20% a year from this stock alone. So that's how the market is working in mysterious ways, which is the market rally typically happens at a very, very short period. And it is very, very hard for us to time when this rally is going to start. We wouldn't know. If everybody is already talking about this stock and everybody is, excited about this stock, yes, the rally is happening for this stock, but that's rarely that is rarely the time for us to buy in the stock. Because typically every rally that comes, it'll come with a crash. But if you find really, really good companies that continue to grow, typically it will grow and it crash and it will grow again and it crash. And by the time, if you let time works its magic, even when the market, when this stock reach its next crash, I think most likely it will still be above the 300 mark, right? It will reach a point where the price that you buy into it, because it's such a great company, the price you buy into it is no longer realistic for it to fall to that kind of level, because the company is no longer the size that it once was. It's so much better, so much bigger. And it happens to many of the stocks that I buy, right? A lot of the stock that I buy into, typically for the first 1-2 years, typically I'll be losing money most of the time, right? And that's because I have to search into companies that sometimes they are unloved by the company. Sometimes they're just not even looked at by the market. Nobody cares about them. And when you buy into it, typically they don't have much hype around it. I'll just show you one example again. Xiaomi, right? Xiaomi is also a company that I have bought, right after its IPO started. I started to, when it first IPO, then the stock crashed, continued to crash for many years. And I also started buying around 18, 19, around that period as well, right? So this, I bought at around the price of 12, I would say 11 to 15, the whole range that I have averaged it out. But you can also see buying this company for also, I would say 4-5 years, it's not doing anything, because by the end of 2013, so at the beginning of 2014, it's still roughly around the same price of what I buy. But within that short period, when China finally rallied and people are start getting excited about China again, then you see the returns coming again, right? And to work out, right? Even if I hold this stock for 6 years now, and it only rallied for the past year, it's still a decent return. If I work out to a yearly return, it's still roughly about 19.5% return on average. So this is actually how a very typical way the stock market works. That the rally comes at very short pockets of times. And if we are always trying to just find that pocket and buy at the bottom, sell at the peak, I would say we will make more mistake than we'll make much more mistake in the market. And a more realistic way and a more stable way to do it is really just don't worry so much about the market. Find great companies to buy in and at a price that we're comfortable in. If the company is really that great, it will continue to grow. And one day the market will realize how great it is. It's just the way how the market works. Right? So as a summary again, we look at company with good business, good management, the financial match, what we look at, and finding a valuation that we are okay with. We're okay with. And all this is the process, I would say, from what I understand, how the closest that I can come up with as a summary of how Buffett would think to invest. But when it comes to building wealth for the long term, a key part to Buffett's success and to a lesser part all my personal journey on how to create wealth from the stock market is really having that system in place. It's not really the stock that you buy. It's not really how fantastic that you bought Nvidia at when it's $10. But having this system, right? The system that I talked about Buffett just now, of how he can have this flywheel of having the insurance that gives him money to invest, and then he can buy businesses that generate more cash flow, and he has more and more cash to invest into stocks that continue to give him more dividends or continue to grow in value. So he has this system in place where he constantly have more and more capital to grow his wealth over time. And on a personal level also, right? And it's something that I work closely with a lot of my clients, is also building up this action plan of this solution and having this system in place by understanding your financials and deciding, right, from my financial, okay, I do have excess savings. How much of this excess saving do I want to put aside and invest in a regular basis, right? I will constantly, maybe I have excess income of, say, 30%. And I decide that I will invest 20% of it constantly. So having this plan that whatever happens, this 20% goes into my investment account, no matter what, no matter the market is up, no matter the market is down, this money is going into my investment account and I'm not touching it. Having that constant flow to allow you to have always a capital to invest, that's actually the key to building long-term wealth. And also, it gives you the confidence to spend your guilt-free money, because, like, say you have 30% of excess cash, but you're investing in 20, then you have the 10% excess, and that could be your guilt-free spending, right? You can very, very happily spend on whatever you want to have whatever luxury lifestyle that you want using that amount and not feel guilty about it, right? The problem is when we don't have this action plan, that we don't have this constant process of allocating into investment. What happens is, if we have excess cash, it will build up in our cash in our bank. And what happened when we saw that our bank balance is increasing constantly? I know very well, for myself, right? If it grows too big, then there is a tendency that we will fall to the lowest denominator, which is we'll just fall into pray for marketing. Whichever comes in life, the next shiny thing, I want it, right? Be it the next exciting EV that's out in the market, be it the next holiday that my friends are on and I haven't been. If I have excess cash in my bank, that's where I'm going, right? And the key to life, I think, is actually the balancing act. It's not that we cannot enjoy all these things. Sure, we can enjoy all these things. Do we want to enjoy it now, or do we want to enjoy it later? Or can there be a balance? Maybe 50-50. I want to enjoy some now, I want to enjoy later. I want to enjoy now with a peace of mind that I still can enjoy it later. Right? How do we create that balance? How do we create that system into our life? And basically that's something that I spend a lot of energy and effort in with my clients on reviewing that using software, right? This is a software that I use to simulate out the entire financial status of my client, including doing simulation for them, right? If they want to buy a new property, if they're planning on a new child, if their child is going to university, how would that look out for their financial in the future? And also planning, right, for risk management, like if they fall into sickness, is their insurance work out for them? And only then we know we can allocate out what is the good sum of money that they can put aside to invest while still enjoying the lifestyle that they want. And the investment part goes back to my philosophy of finding long-term opportunity in the market and not to worry about the market ups and downs, and building a portfolio that's truly everlasting in the future. Right? This is just a summary of some of the example that how I build up a portfolio for my clients through my FI platform. And we talk about the idea of compounding, right? The idea that even just a little bit of excess return, say today you put your money into EPF, very good, 6.3%. In the past also 5+%. So average out, if you can consistently get from EPF, say a 6%, that's pretty good. But just having maybe a way to boost that by 1 or 2%, over the long term, that 1 or 2% can balloon to a lot of money, right? This is just a simulation I done for a portfolio. If we start at 100,000 and we just let it run at 8%, at 10%, at 12%, just every 2% difference on how the money will grow, that money could grow to a difference of millions of dollars in the future from $100,000. So that's something for us to ponder upon. And of course, I did it. I also want to again share with you guys our iFast platform. Even just if you want to trade stock on your own, it's a great trading platform as well for you to look into. But if you want to speak to me one-on-one, do remember to join our waitlist Google form, or just reach out to me from my email or from my website. You get all my contact detail into it. Before we go, I'll just do a quick practical example with you guys on how you can scan the stock that you want. Let me go back. I'll go back to our screening tools. Give me a minute. Let me share again. Okay, I'll just share with you guys. This is actually my own iFast account, but we can use the stock screener. And you can see that from the stock screener, from all the things that we talked about just now, let's do a simple screen, right? I want a company with low debt, right? So its debt could be 0, but no more than 1 times. Okay, so what other things we talk about? The growth rate. So revenue, I want it to be at least growing maybe 10% a year. Maximum, I don't want it to be too much. Too much typically is unrealistic and it could have a lot of outliers. So say this company can double every year, 100%. That's already quite crazy. Then the net profit also maybe growing faster than the revenue, signifying that the company actually can increase its margin because its rent income is growing faster than revenue. I want a company like this because it shows that the company has pricing power. It can increase its price and people still buy. Okay, and maybe also not too much. Let's put it at 100. Gross margin, maybe let's say simple ones, even if it's a brick and mortar, let's have it at least 30%, but I don't want it to be over 100 because there's no reason that the gross profit is higher than revenue, unless for financial engineering. So maybe 90 is considered very high. Net income, maybe 15%. Net after paying all the taxes, still 15%, pretty good. Also, less not more than 50% if they pay tax. Return on equity, just now we mentioned, right? Let's have a company that has at least 15%, but also not too crazy. 100% is already very crazy. And valuation, typically when I screen for companies, I wouldn't touch on the valuation because I want to look at it to make sure that I find the good company first, and then we think about valuation, right? And then we can screen for all the markets that we have on IFAS, which is the Malaysia, Singapore, Hong Kong, US, and also the China market. And I'll screen for that. Oh, I lost it. Let me do a quick one. Very, very quick one. 10%, 15%, minimum 30%. This one, 15%. Okay, just as a sample for you guys to see, to understand how you could do it as well. And screening through all the markets, and you can see it still give me quite a decent size to look at, like 100 stocks, and give you a lot of things to research on. You can arrange it in terms of market cap, in terms of market, in terms of how fast it's growing. You can see some of the great companies, Microsoft, Nvidia, Netflix is still here, all the great companies. And then we can download this thing into for later. For all the premium card members, I'll also upload this screener up for you guys, for you to download, so you can check it at your own time. And yeah, thank you so much for your time. I'll come back to the business that you guys, the question that you guys can look at, and then we can take it from there. I just have a few finishing slides, and then we'll call it a day. Victor, again, thank you for your question. Your question is, what gives you the conviction to continue holding on to Netflix? You mean after holding it for a few years that it is still it's not profitable for me, but I'm still holding on. So a few key things. The business itself is still growing, right? The stock price is not growing, but the business itself is growing, and I can see that. And I can see that they really have very, very strong pricing power. This is after Disney started really banging on Disney Plus, and all the Hollywood studio has their own streaming services, and yet you don't see a drop in Netflix subscription. And I myself has tried it, right? I myself have tried it, that because I was subscribing to Disney Plus and also to Netflix. Then I tell my wife, we don't really have so much time to watch so many things. I'm going to cancel one. And when I try to cancel Netflix, everybody complained, right? My kids, my wife, even myself, I cannot. When I cancel Disney Plus, actually we can still live with it. So of course, these are just personal antidotes, right? I don't value them very, very high, but just personal antidotes on showing that Netflix does have pricing power. It has been increasing price over the past few months for multiple times already. And I just suck it up and pay. Many people also does, because you can see that their subscription numbers never drop. And it just shows the power that they are basically becoming the new cable, right? Previously, we have our StarHub, our Astro. Basically, Netflix is the Astro now. Easy as it is. Okay, So thank you for the time and for the question. Caroline asking a question on why Netflix have a sudden drop, but yeah. And I think Victor, thank you for helping with the question. HL Tan has a question is what is the ratio to look at? Let me see. Something is blocking my view. Sorry. What is the ratio to look at to say the company has good free cash flow? And also number two, for good margin of safety, how much % below intrinsic value should we look at before buying the shares? Okay, let's go at question number two first. I think just now I talked a little bit about margin of safety. It's really a personal number. Previously, I have very high margin of safety, like 30-40% to the value that I want to buy it at. Over time, I realized that it doesn't really work. Number one, it restricts me from buying a lot of group companies just because I cannot get it at the price that I want. Then also, number two is I realized that if the quality of the business is higher, like if this is really a very, very unique business, typically there's no the margin of safety comes from the quality of the business, right? I don't really need the price to be good already because the company is like one of a kind in the whole world. And that by itself can be seen as a margin of safety because there's no replacement for this business. And that's basically how I look at it. At the end of the day, it's a personal preference. So I would say experiment with it and see which one fits you. And it doesn't need to be a fixed rule, right? As you evolve, you can change it over time. And number one is what ratio to look at to see that the company has good free cash flow. Typically, over time, I would say I don't really look at the ratio that it has good free cash flow. But the free cash flow, I typically would add them all up. Say 5-10 years, I add them all up. And I want to see that free cash flow is more or less similar to the net income figure. Because I feel that the net income figure from year to year, it might be different because of accounting standard of service rendered or prices. You haven't collected the money, you sell the goods already, you haven't collected the money, blah, blah, blah. For year to year, there might be difference. But if you stretch it over the long term, it should more or less come back to a similar figure. Typically. And so that's how I can tend to look at it. Instead of a figure, I want a long-term figure of free cash flow close to or even more than the net income. Okay, and I'll go to the last question of Victor, and then I'll finish off the last few slides. Okay, Victor said, Stanley, do you shift your focus to quality investing, compounding? And would you be willing to pay more than intrinsic value if the growth and quality of the business remain? So the first question is asking if I have shifted my focus. I think yes, I have shifted my focus to like finding high quality business for a long time now. Sorry, my tongue is getting tight after 1 hour of talking. But yes. So the example that I give on Netflix and also Xiaomi and all that, I think around 2016-17, I started really moving more and more towards finding high quality business, and which I think in the past I started out as a very value investor, right, finding very cheap stock, and then I become a mix of it. But I would say around 2017-18, I started to move mostly to high quality companies, and that's what I have in my portfolio today most of the time. Are you willing to pay more than intrinsic value? I would say yes. I have done that before. I would still do that if it's not too crazy. But typically I would still want the majority of my portfolio to be wonderful company at a fair price. I'm okay for it. But maybe on and off, 1 or 2 smaller position, I don't mind paying like a crazy amount if I really feel this company is very, very unique. But having said that, this is also how you size the portfolio. It will be a position where I might don't mind if I lose that money, right? Say it could be like a 1% or 2% position. I know that okay, this company is very very unique. Price is has never come down. I might buy it, but if I lose out the whole 1%, so be it. You know, and that's where I see it as a allocation venture. Okay, thank you so much again. If you want to talk to me one-on-one, remember to reach out to me here. But as I always finish my webinar with a few things, which is number one, our spin-off section, just something that I feel I want to share with you guys. One thing, if you guys do not know, I am quite avid tennis player and not very good, but it's just something I enjoy. But and one of the key person that really influenced me into the game of tennis is of course Roger Federer, right? And I still practice my one-handed backhand because I see him playing it so when I was young, and it was so beautiful, the most beautiful shot in tennis. And I just re-watched his commencement speech from Dartmouth. So I think it's a fascinating read. Once in a while, sometimes I would search up these commencement address and just rewatch them, just to motivate myself a little bit back, and just to remind myself of the things and some of the key lessons I learned and key life philosophy that I adhere to, that is similar to them. One of them is of course listening to Federer. And I encourage you guys to just search on YouTube. It's just a short speech. And a key point he made is, even for him as the best of the best player, he loses close to half of all the points. Now he only wins 54% of the points that he played in tennis. He only wins 54% of all the points that he played, although he wins like 80% of the matches, right? And it reminds me on why failing is so important in life and in investing. And we should not be afraid to fail. And I see a lot of people just so afraid of failing that it paralyzes them, that they don't know what to do because they don't want to face the fact that they might fail. And failing is really part of life. And the faster that we accept it, the faster that we get to enjoy the full experience of life. And also in investing, in investing, because at the end of the day, investing is just a game of probability. You can never win 100% in all the stock that you pick. Of every single year that I track my portfolio, I have never once had 100% hit rate for that year of investing. And I would say I come close to hitting 100%, which is last year, and that scares me a lot, right? Because typically such a huge market rally typically scares me a bit. So that's something for us to keep note, right? Failing is a part of life and investing. Just take it as it is. And another key point that you make is effortless is a myth, right? Because when you see him play, it's really like he's not breaking a sweat. Like he looks it so simple, but to make it so simple, to make it look so simple, he has to work very, very hard into it. So I just like to end with a quote, of course, from him, from that speech. It's a bit long, but bear with me. But his point is, in tennis, as in life, you will lose points and matches and even the entire season. The key is not to let this speed bump brings you down. We have to accept and learn from your losses and look forward. And it is natural when you're down to doubt yourself and to feel sorry for yourself. But negative energy is just wasted energy. You want to become a master at overcoming hard moments. You move on. You be relentless, adapt, and you grow. You work harder and you work smarter. So That's all that I have for you guys. If you're on this journey as well on building your portfolio, I wish you all the best. If you want to speak to me on this journey as well, I am privileged to hope that I can speak with you. So till we meet again, my name is Stanley. Invest safely, guys.